Something big just shifted in the energy world, and most people haven't noticed. Oil companies are suddenly scrambling to lock in CO2 pipeline access, storage rights, and tax credits. Exxon just paid $4.9 billion for a single piece of infrastructure. Occidental is betting billions on technology most people have never heard of. This isn't climate virtue signaling. It's a $72 million to $170 million annual revenue opportunity. And the window to participate is closing fast. In the next few minutes, I'm going to show you what CCUS actually is, why the math suddenly works for oil operators, and what happens if you don't move now. This is Mark Roach, and this is FutureWise Energy. Let me start with the simple version. CCUS stands for carbon capture, utilization, and storage. That's probably not news to you, but here's what is. There's a hidden fork in the road, and every Permian operator is facing it right now. You can either use captured CO2 to pump more oil, and that's called enhanced oil recovery, or EOR, or you can store it permanently underground and collect tax credits for a century. Or smarter still, you can do both. Think of it like this. Imagine you own a depleted oil field. For 40 years, you pulled oil out of it. Now it's mostly empty. That empty space is worth something now. You can use it either to recover the last bit of oil with injected CO2, EOR, or you can use it as a permanent vault for carbon dioxide. Well, the oil upside is temporary. 4 to 6 years of higher production and then it depletes. But the storage upside, 100 years, maybe longer. And here's where it gets interesting, or even more interesting. You can do both in sequence. You can use CO2 for EOR first and make money on the extra oil that you produce, and then transition the field to permanent storage. And that's called the hybrid play. And it's the smartest move in the Permian right now. Let me show you why the math suddenly works. The US government extended something called the 45Q tax credit through 2032. Before 2023, these credits were worth $50 per ton of CO2 stored. Now they're worth $85 per ton. They're also indexed to inflation, so that number grows every year. So let me put that in perspective. If you have a sequestration project that's capturing 100,000 tons of CO2 per year, and that's the size of a mid-scale hub, your annual tax credit is $8.5 million just from the government support. And every year you get that for 12 years. And on top of that, carbon credits are emerging as an actual market. So that same 100,000 tons might generate another $10 million annually in carbon credit sales. Operating costs? Well, call it $1 to $2 million a year to monitor and to verify storage. The net margin? $11.5 to $15.5 million per year. And over 12 years, that's $120 to $170 million in net present value. And here's the critical part. The Treasury, the United States Treasury writes a check. You don't even have to have tax liability to get the money. You just need to file the permit, place the project in service, and the government sends you a check. That's the mechanism. And that's why big oil is moving. Well, here's the fork, and this is the real choice. Option A, enhanced oil recovery, the bridge play. You deploy captured CO2 to squeeze more oil out of depleted fields. The CapEx is moderate, $40 to $80 million per field, say. You see returns in 4 to 6 years. You get oil upside plus $3 to $10 million annually in 45Q tax credits. The real example? Well, Oxy has 60 plus EOR wells planned for the Midland and Delaware basins, and that's in the Permian Basin. And they're targeting 4,000 to 12,000 barrels per day of incremental production by 2026. The advantage? Proven technology. 40-year track record. Oil revenue subsidizes the CO2 infrastructure capex. The risk? You're exposed to oil prices, and EOR fields eventually deplete. It's not a century-long revenue stream. And then option B, permanent sequesterization. The recurring revenue play. You build a CO2 hub, a shared network that injects CO2 into Class 6 geological formations for permanent storage. Now, CapEx is higher, $800 million to $2 billion per hub, and that's shared across 10 or more industrial partners. But the payback is perpetual, 8 to 12 years to recovery CapEx, and then $3 to $5 million annually in recurring 45Q credits forever. No commodity exposure. The asset lasts 100 years or more. Real examples? Exxon's Dorado site in Texas has hit 115 metric tons of storage capacity. Occidental's South Texas hub has potential for 3 billion metric tons. These are multi-billion-dollar infrastructure plays. The advantage? Inflation-protected recurring revenue, zero oil price risk, massive scale potential. The risk? Regulatory Class 6 permitting takes 2 to 3 years. Carbon credit markets are still immature. You're betting on policy durability. Now, the hybrid play, do both in sequence. Well, here's the masterclass. Deploy CO2 to EOR first, maybe 2025, last year into 2027. Capture early cash flow and 45Q credits from oil production. Then, as EOR fields mature, transition from the infrastructure to permanent sequesterization, 2027 to 2030. You amortize the DAC CapEx with oil revenue early. You build a scalable sequesterization business later with zero oil price risk. That's what Occidental's doing, and that's the template. Well, here's the thing that most people miss. Not all operators are equal. The Permian has a 70-year subsurface data advantage. Engineers in the Permian know these rocks at a level of detail that greenfield sites just don't have. Depleted reservoirs in the Midland and Delaware basins are perfect for storage. They've already been proven to hold hydrocarbons for millions of years. CapEx for sequesterization in the Permian is $200 to $400 million lower than greenfield sites. Plus, here's the existing pipeline infrastructure that's already there. There's existing power. There's existing labor and supply chains. Well, that's a competitive moat. Permian operators who move now can acquire storage capacity and pipeline stakes at favorable economics before these costs inflate. This is the critical insight. Whoever controls CO2 pipeline networks will dominate the next decade. Denbury Resources operates 1,300 miles of CO2 pipeline in the Gulf Coast and Permian. Exxon paid $4.9 billion to acquire Denbury in 2023. Not for their current EOR business, but for the future optionality. That pipeline can feed sequesterization hubs for the next 50 years. Limited CO2 transport capacity is a bottleneck right now. First movers who secure offtake agreements or minority stakes in hub infrastructure now will have 3 to 5 year competitive advantage before capacity catches up. Now the clock's ticking. Class 6 permits take 2 to 3 years. If you don't file in the first or second quarter of last year, then you're looking maybe at not getting your operational startup until 2028 at the earliest. So that's 2 to 3 years of lost 45Q credits. If you don't file in Q1 or Q2 of 2025, you're looking at 2028 operational startup at the earliest. That's a 2 to 3 year loss of 45Q credits and lost market position. Not every basin is created equal. The Gulf Coast, Tier 1, massive emitter concentration, existing pipeline networks tax optimized. Denbury's network dominates. For mid-sized Permian operators, the play here is an offtake agreement or a minority stake, capital light, maybe low risk. Permian Basin is Tier 2. Brownfield advantage, existing oil infrastructure, natural repurposing opportunity. EOR in Midland and Delaware basins leads sequesterization development in South Texas. That's why where the Permian operators own the advantage. And then there's the Rockies in Canada. That's Tier 3. Sparse emitters, regulatory uncertainty. Wait and watch. Canadian federal policy clarity just isn't there yet. The strategic implication, Permian operators lead with EOR. Brownfield CapEx, $40 to $80 million. Fast returns. In the Midland and Delaware, participate in hub infrastructure, minority stake or offtake for sequesterization. Avoid direct capture capital expenditures. Leave that to Occidental, Exxon, and DAC specialists. Well, here's the question everyone asks. Will this survive politics? The Trump administration confirmed 45Q support as bipartisan. That signals durability. The credit appeals to both climate advocates and domestic energy independence hawks. Big oil is voting with capital, and that creates political momentum. Could policy change? Sure. But the trend is locked in for the next 5 to 7 years, and that's enough runway to execute permitting and reach operational startup. So let me sum this up. CCUS is not a climate story. It's an economic story. Oil operators don't need to believe in climate commitments. They just need to believe in $70 per barrel oil or $85 per ton tax credits. The math works standalone. The window is narrow. Permian operators who file Class 6 permits in the next 90 days will reach operational startup in 2027 to 2028. First movers will capture 3 to 5 years of advantage over others. Brownfield repurposing of depleted reservoirs in the Midland and Delaware gives Permian operators an asymmetric edge. If you don't have a CCUS strategy by the end of last year, then you're probably going to be locked out of CO2 pipeline capacity and offtake agreements this year. Now you understand what's actually happening, and that puts you ahead of most. I'm Mark Roach, and this is FutureWise Energy.